Okay, so let's zoom right in, and we are at 175% zoom. And here we go. So we've got our construction finance option. So we are looking at this section right here. The reason I zoom out every time we start a video is so that I can give you a context to where we are at. So we are looking at revenue, we are looking at development costs, we've looked at other income, finance costs, we looked at our funding table, we'll figure out the maximum TDC that the bank would consider, and then we've selected some of our funding options. So now we're going to zoom right in and look at all our construction finance options. So construction, so always remember that when you already have a loan on a block of land, most lenders post GFC do not like to get a second mortgage. They would want to have the first mortgage, the first right on the land you're going to do the development on. So you've got construction loan interest, let's say it's 6%. You select that. You've got less land acquisition loan. You've got debt available for construction. Now, all this is based on what you select here from your funding options. So you have three options right here, and you've selected that if I go with this bank's TDC, I'll be paying 65%. If I go with the project TDC, I'll be paying 66%. If I go with the project GRV, that lender is only going to lend me 60% of the total GRV. So you put in those figures here. So when you are ready to calculate your construction loan, you just select the option that you want to go with. So in this scenario, let's just go with bank's TDC. So if I select bank's total development cost, everything will start changing, and this is where the magic is happening, and I'll get to it in a second. So then you've got less land acquisition loan. Whatever loan that you had for the land will get deducted from here. Your construction period, you would have spoken to your building contractor who says that it'll take him 14 months to build this thing, and then your closing period, that means after the building is complete and the builder hands it over to you, there's going to be some time when all your pre-sales, all the sales that you've done, they will need to pay you the money to settle on them. So you got to allow for a closing period in there. Loan setup fee, whether or not it includes tax, you need to select that here. It's in some cases it does. It's basically that GST thing, but you don't have to worry about it because we don't have any of that at the moment, and we'll come back to it. So loan setup fee for your construction, usually 1% of the total loan, or 1.5% in some scenarios. So you can select that amount over there. Then the land interest costs during construction. So what we are doing is we're capitalizing the interest that we will need to pay during the 14 months. So you still have a loan on the land, and you still need to calculate it. So if you wanted to calculate it as a separate interest for that, you can put a separate number here just in case you've got two facilities. If not, you just leave it as 6%. Then you've got your construction interest drawdown rate. So this is the intensity at which the construction loan comes out. I usually allow 60% intensity because that means that I'm not drawing the entire approved loan amount on day one of my construction. So as the construction goes up in an S curve, and if you want to get into more detail about this, the lead developer feasibility application has all these things, breaks everything down into S curve and so on. So, but because this is for a small to medium-sized development that will start and finish within a 24-month period, I don't want to get into that much detail. So I'm going to go with 60% right here, and based on that, I'll get my interest calculated. Now, what is happening here in this feasibility, and what's unique about this, is that this number here, whatever the interest calculation is happening here, goes back in here, and then we recalculate the loan, the maximum loan amount that we can get, and it does that a number of times to come up with a probable value. So that is what is unique about this. So you don't have to worry about what's happening in the background. You just select the type of option that you're gonna get. So if you want to go with project GRV, for example, you'll see that you'll be able to borrow a lot more, and you'll have to come up with a lot less money. So suddenly you just saved about 300K here of your own money. So the idea for development is that the developer uses the least amount of their money in order to do the development, so that they can get the maximum amount of return on their own money. So and that'll give you your finance costs and so on, and those finance costs will then get iterated and added, and that's how this will work out. So that's your construction finance sections. Below you'll get your total developer costs, or finance costs and so on, and you'll see that you're only making about 30,700 on this project. Why? Because we have our construction cost and our total sale very close to each other, yeah, that's where this is at. So unless you've got something wrong here, so let's say you want to go with something like you know that it can be sold at $810,000 a unit, and this will again do the calculation based on it and tell you what you can make in this project. So this is your tax liability. So if I open that up, so if you know what your tax liability is going to be per unit, you can put that in and it'll deduct that from here if you want to get an after-tax earnings. Otherwise, this tax liability section is mainly used to calculate GST, but because this does not have GST, I won't get into it, and I'll take it up when we get into the GST section.